Hello.
Hi, Steve.
How you doing, Sylvia?
Very good. So I'm very delighted that we can finally get to do this. Um, Please start by introducing yourself, and then, because I don't have your bio with me, just tell us briefly about your how you found yourself into trading, and you can touch on the swing trading options contest that you had told me about earlier, and how that was like for you.
Okay, so I've when I was in high school, I actually when I was 10 years old, I first got introduced to it through my granddad in a way. We were driving down the highway and we saw a Caterpillar dealership, and I was 10 years old, and he said that when I get older, he said I should buy stock, and the three stocks that I should buy is Caterpillar, General Electric, and Sylvania, which you can't even buy Sylvania anymore. Uh, and he said you get your first paycheck, buy stocks with it. So then I started thinking about when I got into high school, instead of going to lunch, I would go to the library and I would read different. I would read like Forbes magazine. I would read Fortune magazine. I would read Wall Street Journal, different things to keep up on stocks. I started following tickers in the newspaper to get an understanding of what the particular stocks do, especially the ones that I liked. And by my senior year, I said my first $10,000, I'm going to buy these stocks. And I listed 5 stocks and up to 7 if I could do it. And the 5 were General Electric, Caterpillar, Home Depot, Intel, and Microsoft. And then if I had it for the 6 and 7, I would do Walmart and Papa John's Pizza. And
Okay.
then, so what's that?
That's very interesting. I'd like to know how you got the first $10,000 before your senior.
So I got my first $10,000 after my senior year when I graduated, and then I got my first job. That was my goal with my first 10,000. But I started dating who's my wife right now, and so when I got the $10,000, I totally forgot about my goal, and I spent all my money on her, trying to win her over. And then I also paid for college. So when I graduated college in 93, this 88 was my goal. In 93, I graduated college, and I realized I forgot about my stock goal, even while my last year or two in college, I was following the market during the Bill Clinton years. But I wasn't following particular stocks because I was very involved in college. I was just following the stock market as a whole, watching how it was just growing. It was like 1,500 at the time, and now what is it? 100, 10,000 or whatever. So so then I went to graduate school, and I still was very involved in graduate school, and I always worked a lot. So I always had 3 jobs going I had 3 jobs when I was in college. I had 3 jobs when I was in graduate school. So I didn't really have much time for individual stocks, but my senior year of graduate school, and this is now late 90s, that's when I said, okay, now I got some more time, and I'll go back to my goal and what it was. And I changed those stocks, but I started investing at that time, but doing trading. I went from investing to trading. When we got married, my wife had a mutual fund account. And so I worked with investing, doing all the things that I learned in my high school years with IRAs and mutual funds. And you asked, one of the questions you have down the road is about mentorship. And I actually stayed with a couple when I was in high school. I lived with them for a little while. And she was an investor in IRAs and mutual funds. So she taught me a lot about it. And that was my first mentoring with stocks and stuff. So back up again to 1999, I started trading stocks. And I started in the .com. But I graduated in 2000, right about the time of the collapse of the .com. So I got to experience the collapse more than anything else. I had like several months of incredible gains and then a couple years of incredible losses. But I always stuck with it, knowing that, when the market drops, that's the time to buy. So it kept getting lower and lower. I kept buying more and more. 2003. Okay, oh, go ahead. Sorry.
How important was that mentorship to you, especially during that .com era? When the market was going all crazy.
So the 2 big things I learned from it was the market's always going to have cycles. So it's always going to have these down times, and that's the time to buy. Second was I knew I was in my 20s still, and even the early 30s. I have all the way till I'm 70 at least to make up for whatever losses I got. So just buy. So then I was also studying Warren Buffett at the time. Just buy sound companies, and when they're low, or sound mutual funds even, when they're low, that's the time to buy. And the big one was from Warren Buffett: when everyone is afraid, you be courageous. When everyone's courageous, you be afraid. So when all that fear is there and everybody's selling, that's the time to buy. So that really helped me, and that helped me gain back my money quickly. So in 2003, I had a banner year. By 2004, it took to about 2007 before I made back all the losses from 2000 and had increased it to where we doubled our net worth by 2007. We were doing very well. Then 2008 hit. And 2008 was the game changer because that's where I saw, it took a 2/3, because I'm a very aggressive trader, an investor even. I took a 2/3 loss on our net worth. And then the mistake I made was listening to news and publishing companies like Motley Fool and stuff like that. And they were all saying, it may take 10 years to get your money back. We might see more 2008s now. We might see 2008 every 3 years. And I'm sitting there thinking, doing the math, there's no way I'm going to make my money. If I have 10 years, it happens. I'll always be stuck at this net worth thing where I get up to, several hundred thousand, drop down to 100. I'll never get to my 7-digit goal. And so I'm a little frustrated at that, and I asked questions. And meanwhile, I was working at a job, and all this, there was this land, a lot of land around, a lot of farmland. And there's only like 5 families that owned all the farmland. And I asked people around there, how did they get the land? And they said, well, during the Depression, when farmland was real cheap and everyone went into bankruptcy, these people bought the land. They bought it real cheap, and now it's worth millions. So I'm like, okay, well, that must be what they do in the stock market, because I know people were making money in 2008. Even Warren Buffett made money during 2008. So I started asking questions, how to be like those people who make money while the stock market's going down. And so there's like 5 questions that I asked. I was already with TD Ameritrade, and TD Ameritrade sent a letter, and they said, are you asking these 5 questions? Or are you asking these questions? And every one of them were the questions I was asking. And then they promoted investtools.com. Here's the answers. So then I bought into investtools.com. That was 2010. And that was my introduction into options. And then 2011, I realized if I'm going to be successful at options, and this kind of leads into one of your other questions, I'm going to have to treat this like a business and not like a side job or even a hobby like I had done with mutual funds. And
Okay.
so I started taking it very seriously from there.
So initially you started out in stocks, and then you found your way into the options.
Went from mutual funds to stocks to options.
Okay. So now you're dealing in options specifically.
No, so now I've always still have mutual funds because of retirement accounts and college accounts for the girls. So I still have those mutual funds going, and it's matching with the employer, so that just makes a lot of sense. And my mutual fund accounts have always beaten the market. So even, I tell you what, from 2000 to 2010, I went to Edward Jones. I don't know if you've heard of them, but they're a financial advising and not a brokerage, but a mutual fund holding company here. And I went to them, and I met with the district manager, and he did a portfolio run of my account from 2000 to 2010. And that includes my stocks that I bought during 2008. Right around the beginning of 2009, I started loading up on Citigroup, General Electric, Microsoft, AIG, different things like that when they were really, really low. So from 2000 to 2010, he ran a portfolio analysis, and I made 13.5% every year. On average, I averaged 13.5% over that 10 years. And that included the dot-com bubble and 2008. And he said, we can't match you. Only thing we can do is offer you a job.
Actually, that's more impressive than the performance of most mutual funds at the moment right now.
Yeah, and I did really well. And the mutual fund company we use primarily is Fidelity and American Funds. And American Funds struggles a little bit. But I started getting to Fidelity Select Funds. So I started understanding sectors better, technology sectors, things like that. And that got me introduced to NASDAQ versus SPY versus Dow Jones, stuff like that. And so I still do stocks. I just love stocks and I love getting a dividend, but I also do options as well because I like the accelerated money making potential, the risk to reward, and it just keeps me engaged and active, and I like that. So I do all three now, but my daily work is the options.
Okay, and at some point during the swing trading contest, you told me that the coach once halted your, for you to join the contest because you were outperforming and outshining the rest. Can you explain that?
Yeah,
Yes.
it's pretty funny. So the investors.com had 50,000 students. Probably anywhere between 3 to 5,000 students were very active at the time, and they had a community that you can do. It's a very interactive community, and they wanted to get students involved, and I was involved in that. And you could go up your rank from, beginner, the novice, and they go all the way up to like 12 levels, and the 12th level is an ambassador when they finally say, okay, these are students that we want to use to help the other students and to integrate them into our investtools.com network. And I end up being one of only 11 ambassadors out of the 5,000 students. And a lot of that was based on this trading contest from one of the coaches. There were 40 coaches. One of the coaches had a stock trading contest, a stock investing contest, and then an options trading contest, all based on InvestTools rules. But there was an allowance for you to modify InvestTools rules because you're not going to make money doing it any formula. You have to modify it, right? So I was allowed to modify it, and I modified it according to the best coach that they had. And he didn't even use InvestTools rules. They just kept him on. He was kind of a maverick. And going back to your mentoring question again, he was a huge mentor for several years. So, and I was one of his kind of star pupil type deals. So in that trading contest, when I started it, they're like 6 to 8 weeks long. And out of 7 of those 2-month trading sets of time, so in like a year and a half, 2 years, I won 6 out of 7 of the options trading ones. Then the stock trading ones, that 2-year period of time, I won 3 of them. And then the stock investing one, I won 1 because I was doing trading at that time. I had left investing world and had just done trading. So, but even still, I won that contest. So I was the only trader, the only InvestTools student, and won in this contest. So probably a couple hundred students overall. That he had to make a new category for. He had these different awards, and mine was whatever it was, King something. That I was the only one that won all 3 contests. And I had won the options trading one. You had to have $10,000. You could have no more than 3 trades on it any one time, and you can only use that $10,000 capital. And I would start out with $10,000, and in 6 to 8 weeks, I would have $30,000. I was the king I had the highest capital total in all 3 contests. I was the only one to win all 3 contests. And then if they were to rank it as far as who had by points, who came in first, second, and third, if I didn't win the contest, I was second or third. So I had the highest average of all 3, highest point total, and I was the only one to win all 3. So every time he did a contest, he would have to change up the rules to make it tougher on me. And after my 5th win, he couldn't even make it tough enough that he said, look, other students are complaining. Can you just take a break from the contest because no one's going to participate as long as you're in it because they know you're going to win. And if you won, then they would send you, gift bags and stuff. And I would say, keep the gift bag, send it to number 2 guy because I had enough. I didn't need any more. So.
Oh, basically, that wasn't your crowd anymore. You were clearly playing at a different level. I think so.
Yeah, and the reason why it goes to one of your last questions, what does it take to be an options trader? And when a couple of the reasons is what set me apart from the other students.
So would you say during the contest, would you say your performance was as a result of beginner's luck, or you really had a strategy that you were executing on, that you knew what you were doing?
Pure strategy. So I was an ardent disciple of this one coach named Dave Johnson. And I think his mentor was a protege of Peter Lynch from Fidelity. And I could never prove it, but he would just, every once in a while, he would drop a hint. He would always kept talking about his mentor. That's all he would say. He would never say the mutual company he worked with, but he would drop hints like it's the first mutual company to have $1 billion mutual fund. You know, it was like when there were other billion dollar mutual funds, it was the only one that had 5. So doing the process of elimination, I knew the one company was in California. I figure it has to be Fidelity or something like it. And if it's Fidelity, then his mentor's mentor is probably Peter Lynch. And Peter Lynch was one of my financial heroes when I was studying mutual funds. So I was an ardent disciple. I sucked in everything he did. And all he did was he focused on price action and candle patterns. And, you know, he would use the MACD histogram as backup. He would use volume as backup, but primarily it was simply candlestick patterns and price action. What's the trend doing, and what are the candle patterns telling us? That's all I did. And it was, fortunately, it was a luck involved in, like the Henry Ford thing, 10% ingenuity, 90% luck. It was during the quantitative easement era. And the one thing I realized between quantitative easement and then the lack of the post-quantitative easement era is those bull flags are a lot more dependable when the government's supporting it than when the government isn't. So I could trust those bull flags. And based on his entry rules, exit rules, and things like that, boom, that's all I did. I just took his formula, his rubric, and I applied it to my watch list, and other people just didn't do that. You know, they didn't do it. They didn't do it as faithfully. Most of them could not trust their rules. They had to fall back on what was Jim Cramer saying, you know, what's Motley Fool saying, what's that MACD telling me, what's the VIX doing, you know, what are other coaches at Invest Tools saying? They could never just trust that price action in candles. I did. And so maybe not dumb luck, maybe blind trust was more of an issue, and it just worked. I did break the rules a little bit, as I always got out early because they're options. I would have a target one, and a lot of times the stock would go up to a certain area, and I was tired of it going back, especially a 6 to 8 week contest. I didn't have time for it to go up and back and get before it gets to target one. So I modified my rules to get out to what I saw as soft resistance, and it just worked. And I just kept doing that consistently.
All right. So you would say that your strategy is more technically oriented and driven to date.
Very technically oriented, but in the last year, I've gone back more to Warren Buffett a little bit, in the sense of, you know, strong companies, strong earnings results, looking to see why is that company down. Like, for instance, General Mills is a huge company for me. I just love the company, always have. And Staples were doing really bad, and a lot of focus on General Mills. Well, okay, I look into the sector again. Well, everybody's down in Staples. All the grains are down, agriculture's down, and the grocery stores are down. So I know it's not just General Mills. Then I look at it and I read, you know, the technical articles, technical as in technical analysis, but technical journals, not magazines like Motley Fool, but what are the real insiders saying? You know, even Morningside, even if it has to be morning, whatever. Anyway, I can't get their name out. Anyway, so, but reading what the real guys are saying, what is the real analysis of General Mills? Well, General Mills is increasing their dividend, or they're at least not dropping their dividend. So they're still doing well. I'm looking at their data sheet. They're still doing well. They bought some new companies. You know, they're trying to gain strength, and they're rebuilding. They're meeting the market where it is today, not where it was yesterday. So things like that I paid attention to give me strength to say, okay, you know, it's just a matter of, I'm not looking at General Mills data to say whether or not I want to buy into General Mills. Technical data. I'm still looking at the fundamentals to see if that's a company I want to invest in or trade in. Then once the fundamentals meet my criteria, yes, it is. Then I look at the technicals for the entry points, and basically looking for the bottom. So I still primarily trade on technical data, but I have added more into my watch list. I've done more fundamental stuff to build my watch list. Does that make sense?
Yeah, it does. Now let's go a bit into some education. In simple terms, how would you define an option to, the layman?
The best way to describe it's a derivative. A layman might not get that though. So it's an option is you're not buying the stock, you're buying the option, meaning that you're buying someone's prediction or someone else's instrument of that option. So I'm trying to think of a modern day now. That's your toughest question because I try to get an analogy with it. I just can't come up with an analogy. But so it's just a derivative. You're not buying the actual stock. You're buying what other people have put together, kind of I just can't do it without an analogy, but it's a derivative of a stock, and you're just not buying the stock itself. You're buying the option, meaning you can choose to get in, you can choose to get out. I'm trying to think of something with poker, but not using gambling as an analogy. But you're buying what the traders are putting together. So I guess I could do it in this way. It's like a football pool or something like that. You're not actually investing in the game itself. You're not putting money on the New York Yankees. But what you're doing is you're putting money into a fantasy New York Yankees team, and you're buying that. So I have a buy-in of $100 into this fantasy league, and I'm putting money on my fantasy New York Yankees. And how the fantasy New York Yankees do is dependent upon how the real New York Yankees are doing, or how the real baseball players are doing, or the real NFL players are doing. Whoever the real players are, I'm not making money off of what they're actually doing on the field, because I'm not, going to Las Vegas and putting money on them. I'm not actually investing in what they're doing. I'm not a business owner, so I'm not making money off of their touchdowns. I'm not receiving any money from TV residuals and commercials. However, if a pitcher for the New York, I don't know if you know any players, so I would say a pitcher for the New York Yankees, or LeBron James, if LeBron James is having a great game in my fantasy league, he's going to make me money. So I'm not really making money off of him as a business owner. I'm not making money off of an investor putting money on the Cleveland Cavaliers, but in my fantasy league, which is a derivative of the real league, I make money. And that's the best analogy I can use. I hate it because it has gambling in it, but that's the best way that I can use it. You don't have to put as much money if you're to be a business owner of the Cavaliers or an investor into the Cavaliers. You don't have to get as much money to go into Las Vegas. You can have a smaller pool and smaller money, but the results of your fantasy pool is based upon the real-time results of LeBron James and the Cleveland Cavaliers.
Okay, and to bring the point back home, there are two types of options. There's the call and there's a put option. So what's the difference between the two? And can you use an example, a case scenario where you've had to do that in one of your most recent trades?
Yeah, I seldom do puts anymore, because in my trading strategy, the stock market's going to go up 80% of the time. So I'm completely comfortable, just putting calls on 80% of the time. Also is because I now incorporate that buy low with the companies that are depressed, waiting for them to bounce. When the market comes down, I just look for the sectors that are rotating, and I'll get the strong stocks in those sectors and still do calls. So if I describe it to somebody though, so I haven't bought a put in a long time. I sell puts, but I haven't bought a put in a long time. But if I'm buying a call, I do those every day. So as I look for a bull flag opportunity off of a bounce, I don't like breakouts, but if it makes sense, I'll do a breakout, especially on strong stocks like FANG. But I know if they break out, I have a very short leash that I let them run, because I assume that they're going to come back, as stats are 80% of the time. A breakout stock will come back and find support. We'll test that old resistance and make that new support. So I mostly do bull flags. So if I do a bull flag on my entry, on my call, is I do somewhere around a 40 delta. So let's say General Mills is a recent one. Is it's hit a bounce and it's formed a bull flag off of its what it looks like it's going to be a bottom. So I expect that it's going to run up to the next resistance level. So I'll put in 20-cent entry above the high of the low day. And I have different amounts that I put in for the different costs of the stock. But for General Mills is in the range that I'll put 20 cents above the high of the low day. And then when that's filled, I have my wherever I do my decide whether I'm going to use a stop or not a stop. And then I'll make my target, my stop, target one or whatever. Or if I put in a long call, I'll let it run. So a short call will be 20-day expiration at somewhere around a 20-day expiration, no more than 30, no less than 14. Unless it's a stock like Facebook that I know is going to move and it can move quickly. Then I might do a 5-day expiration, but I'll still do a monthly expiration, and I'll do somewhere around the 40 delta, one or two strikes out of the money on the call side with the 20 to 30-day expiration. Again, it depends on the stocks. And I'll do usually 20 to 25% off the high of the low day. And so a call is you buy a call is you're positive on that stock or you're bullish on that stock and you expect to make money off of it. If you're buying a put, you're bearish or you're negative on that stock, and everything is reversed. So instead of looking for a bull flag entry, I look for a bear flag entry. And a very short leash on those because I expect support to hold even more than I expect resistance to hold. And I have to look and see, does it make sense to get in this at the amount of time and the amount of capital I use? And usually I just don't like put sides. But the benefit of the put side is stocks drop faster than they rise. So if you do get in on a put, then you get off of 20 cents lower than the low of the low day on a bear flag entry, then you can expect to make your money in 3 to 5 days versus 10 to 14 days. So I could do a shorter expiration if I want. And I would use a shorter expiration. I might use weeklies, for example, if I'm going to buy a put and buy a call. I don't have a recent example because I haven't bought a put probably in 2 or 3 years.
Okay, and it's good that you mentioned about the expiration dates. So what timelines do you work with when you're putting on your trades?
So now because I've incorporated fundamentals and because with the Donald Trump era and what it looks like with the market and the business doing so great and all this corporate profits now is I'm expecting a long-term bullish run. So when I get something like the staples or utilities, the two stocks I like, one Dominion Energy on the energy side and utilities has been beaten down. And then General Mills or Kellogg's on the staple side, or even CVS, and that's in healthcare too, is looking at and saying, okay, they may take a while to form their bottom. So I'm going to go ahead and get an expiration out, let's say in January or February. But what I'll do is I'll look at the technical data and see how, and it's more of quantitative data analysis to see how long did they take to form their bottoms. So look at the last 2 or 3, it may take them a month and a half to form a good bottom. So I'm going to get like maybe a 3-month or 4-month time frame to give myself time for it to get through the bottom and then for it to rise. And if I get out to 4, 5, 6 months out and get a 70 delta, my delta won't drop so low while it's struggling through that bottom that when it finally bounces out of the bottom, my delta's so low I can't make any money off it because of gamma. So that's why I like the options way out, because my 70 delta, if it takes, forever, 2 months for General Mills to get out of this stupid bottom, even if it drops more, my delta may drop from 70 all the way down to 40, but 40 is a perfectly good delta for it to start climbing once General Mills starts to climb. If I get a 50 or 60 delta and it drops down to 30 or 20, and then it starts its breakout, there's just not enough juice left in the tank, and the theta will kill me more than the gamma will help me. So if I'm going to do something that's forming a bottom, I do long-term expirations for at least 4 months, maybe 6 months out. If it's just regular trading off of a bull flag, if I were to do a bear flag, then the same thing is bull flag anyway, I'm going to do a 20-day expiration. or basically the next month. If I'm close to the expiration on this month, unless it's Facebook that's going to jump big, I'm going to go to at least 14 to 20 days out, which probably going to most of the time is going to mean I'm going to get the next month's expiration, and I'll do the monthly expiration, not the weeklies.
All right. And at some point, do you ever find yourself trading breakouts?
Trading what?
Breakouts.
Are you saying breakouts?
Yeah.
Yes. So Apple was one recently, and especially with earnings plays, or post earnings plays, I'll do a breakout on that. So there's only a few stocks that I really like breakouts on, and if it's going to be something that I can really look at the breakout history on, like Facebook, and I know that if it breaks out, it's going to break out big. And then if I can see that it has like several days of a breakout before it comes back to reform a resistance, I'll get in that breakout, but I have a very short leash. It'll be, I'll look at the history of the stock. So it's something like Facebook, even a company like LNG that hits that breakout and it's going to run for a couple of days. That stock I'll work through. I'll work with that one. But for a lot of the breakouts, I expect it to last 1 or 2 days and come back to support, and I just don't want to get whiplashed on that stuff. So it has to be a stock that has a history of breaking out with a good breakout before returning back to support.
Okay. So what would you say your trading plan entails?
So my trading plan is I build up a watch list based on all the stuff that I told you before on the fundamentals, or stocks that are just great stocks like FANG, or stocks that have been very dependable to me as far as the charts, that they really stand up to the technical. They do what the technicals say they're going to do. LNG is one such company. If it forms a bull flag, you can bet that bull flag is going to bear fruit. And if it looks like it's going to go to resistance, first target resistance, it's generally going to do that. So I build my watch list on that, and then I'll look and see if there. So what are the stocks that are going with the trend? And those are the stocks I'm going to mainly look at. And I'm going to trade with the trend, bull flags. And I use, again, what this other rubric was from this other coach and his class that he had. He was the most popular and all that. So I use his rubric for that. And then I also now have incorporated the John Templeton, Warren Buffett approach to get these way undervalued, depressed stocks and good, solid companies that are just waiting for either capital rotation, market rotation, or market favor, or some big law to come to pass. Whatever it is, they're just looking for a catalyst or just maybe time to happen. So, and that would be a company like General Mills, General Electric, things like that. And I put that watch list. Then I look for those bottoms. And I have another market indicator that I use for the bottoms, and that's proprietary market tool from Invest Tools, and it's called the Market Forecast Indicator. And I use that, and I look, and using that is when I decide it's time to start buying in to the depressed stocks, doing what I said earlier about long range expirations, things like that. So that's basically my trading plan, and then my investments as far as mutual funds is a whole nother ballpark. But I trade with the trend on 80% of the stocks off of my watch list. I don't follow other people's watch list. I don't listen to news or pundits. I stay within what I know that I can do, and I do it well. I follow the trading plans of the coach, particularly the coach that I like. He's got five rules to that and how to get in and out based on breakouts, divergences, MACD divergences, and those are short term, and based on some of the other indicators that he uses for price patterns and such. And that's basically my trading plan. If it's a call, I now have my trading plan. I modified it. If I get the money, if it makes enough money for me, even if it's not at the target, but it's made enough money for me and it's an option, I get out. If it's a stock, I just let the stock run till I decide it's time to get out, whether I feel it's going to be a market turn or whatever, or I get the dividends that I want, then I get out if I need to get capital or something like that.
I like that you keep it simple and you just custom make it to, to suit your kind of trading. So we're almost winding up. I think the last question would be options and risk management, because some people use options to hedge the kind of trades that they make. So how do
Right.
you incorporate risk management in your trading in regards
So
to
I'm not.
options?
So I'm not nearly smart enough to hedge. And I know a lot of people say that. They say that, they would only use options as a hedge, financial advisors particularly. And then you ask them, what do you do? And they're like, no. So obviously it's just some, rhetoric that they've heard and they repeat. But, following along, or somewhere around 2010 or whatever, Berkshire Hathaway started using options as a hedge. And it wasn't Warren Buffett. He didn't do it. It was his junior officers, and they proved to him that they could do it. So he let them do it. And so they do use puts as to hedge their calls. I don't like their calls. Their purchases. They're bullish. They're always bullish. So they're stocks. But one thing that he said is that people who hedge, period. His whole big attack on hedge fund managers is they don't know what they're doing. They're not confident in what they're doing, or they don't understand the market. If you understood the market and you know what you're doing and you have belief in yourself, why would you ever hedge? So I would never use options as a hedge because of that. I know what I'm doing. Why would I hedge? And I just don't understand it well enough. I don't have enough confidence in hedging. I feel like hedging is just simply mitigating my gains. Why would I want to mitigate my gains rather? And I have hedged when I tried it. I would buy calls on the VIX, and all that meant was I lost more money. It just either I took away from my gains or I added to my losses if the market ended up turning. It just wouldn't make enough off of the VIX because the theta kills you so much in that. And I guess there's other ways to hedge. And some may say, well, buying stocks in a depressed market or a depressed sector like General Mills, that is a hedge. To me, that's not a hedge. To me, that's an aggressive move, expecting that to bounce. So, but some people might use that as a hedge. Well, I'll put a long call on General Electric as a hedge against my positive stock on General Electric that's going down. I just don't do that. And I don't do covered calls either. So some of that's simply because it's too complicated for me. I'm not smart enough to figure out the math and all that. So I just don't do that.
Okay, so then what do you use for your risk management?
So my risk management is a lot of it's built off of this coach's rubric of the formula that they use. And it's no magic formula. They just sat down and came up with it, him and his other coach, and decided this is what we'll do. This seems to be the best way to avoid whiplash and to avoid max loss. And one example, and it's all different, depends on what trading plan you use. So for instance, if I get in on a bull flag, I'll do, when I get in 20 cents above the high of the low day, I might put my stop in at 1% below the low of the low day. So I do that. However, I still hate getting stopped out. I absolutely hate it. So what my trading plan now is mostly is I just use the capital I'm willing to lose to take a max loss on. That's basically my risk management. And I don't use a calculator for it. I just kind of roughly look at it and say, is this reasonable? If I have $10,000 buying capital, then I'll do, up to $2,500 in capital. I'll make trades. No trade will exceed more than $250, $300 loss. I'll do something like that. That's pretty much what I do. If I'm doing a long-term call option, I might do $400, $500, $600 loss, max loss, because I might be able to look at and say, you know what, I'm going to go ahead and get out at, 400 instead of take the full $600 max. But I will put on that much money. So I only put on the amount of money that I'm willing to lose, and I generally don't use a stop anymore.
Okay, we've come to the end of this interview. Where can people go to find you? You can tell us, maybe on your social media handles. And then finally, what book would you recommend any book that you have read that has, cultivated your expertise in trading that you would recommend to beginning traders?
Yeah, it's funny. The ones that have helped me, I've never read a full book. I read excerpts, chapters, stuff like that where I'm at. The one was, and it's not very highly regarded book, but it really was most helpful for me, was a book on option trade. I think it just says strategies for the option trader. But it's not very highly regarded, but it helped me understand the psyche of the market and risk management a bit. But a book that everybody, the Stock Market Wizards, that's the one that everybody, puts out there. I have it, I like it, and it's probably, the one I would recommend the most. Stock Market Wizards, and then the second one they come after that.
So the first one, Strategies from the Options Trader, do you know the author? Do you have the author?
No, it's a real thick book. That's why I didn't read the whole thing. It's really thick.
Okay.
Strategies for the Options Trader. I'm looking at it now. I'm not sure I even have it in my library anymore.
And the second one is by Jack Schwager, right?
Yeah, Jack Schwager. It's not coming up on options trading. It's not coming up.
It's okay. You can get that to me later.
Yeah, I have to look. It's a very thick book.
Yeah. So where can people go to find you, Steve?
So, because I used to be on InvestTools Network, and InvestTools closed down a year ago. They were bought out, and then they were absorbed into TD Ameritrade's world. So that's usually where I was. I'm in insider groups in Skype, but they're by you have to be invitation only. So the only public domain that I have is my Facebook account, Christocentric. That's the only one I have that I can be reached. That's open. Everything else, it's not that I invite people. I've been invited into them.
Okay.
So if anyone wanted to reach out to me and say, hey, what's a Skype, one of the Skype groups you're into? And basically because they were all InvestTools students and because InvestTools is closed down, they're really kind of weak. There's only 2 that are going on strong. One I still participate in, and all I do is I post my charts basically. And there's only 5 of us that are still active in it. The rest are just passive. So okay. Yeah, so the Facebook account's really the best way. All
right, I'll put a link to that on the show notes. Thank you for your time, and I'm wishing you a good day. Bye.
Thank you, Sylvia. It was nice talking with you.
Okay.
You have a good day. All right, bye.